Hello and welcome back to Advanced Tax Configuration Overview. So in this final topic we're going to look at in terms of the strategies really of how you can define the tax engine. So simple terms, it's split between two options. Option one, you've got what's referred to as a simple tax model. So here you use the regime to rate and you set up your foundation configuration. It's probably a bit of a disservice saying it's simple because even this model can start to be complex very, very quickly if you want, because you can vary the rates based on your geography, i.e. the jurisdictions. You can also have product exceptions, customer exemptions built in, and you can also exclude various suppliers from the tax entirely. So a simple configuration normally gives us our starting point. So if I'm a typical customer in the UK, I supply to UK customers, I ship from UK warehouses, my goods are normally standard status or rated, then I would set up my foundation tax to say if I ship in the UK, the standard rate is 20%. Obviously, if I start to export or do intercompany transactions, then that simple model is going to be more complicated. And that gets us on to our choice number two, where we've got a complex model. And again, it's not really, disservice complex. What it means is that core is insufficient to get the tax status rate correct on every transaction. So the likely is the tax authorities have imposed a whole host of rules, whether it's based on customer, based on products, based on type of documents processed, based on the geographical areas. There's all the rules where that means it will override or change the default basis. So in terms of our advanced tax, if we're using rules, you'll find we come down and we've got lots of examples to do this later. We've got a tax determining factor, and that could be a simple one as a registration status, as either registered, not registered. It could be as simple as just using a tax classification code, or it could be using an account, and we can build a factor set that says if. Then what are we going to do? So the condition set is what tells us, the determining factor says which factors we're interested in. Is it further down a fiscal classification? So is it something to do with a party classification, a product classification, a transaction input classification? The condition set tells us what. So it could be if it's a ship to the UK, if you're registered or non-registered, that's where your determining sets get to place. A condition set is then attached to a tax rule. The tax formula, as I say, the taxable basis is normally the line times the rate, or it could be in terms of one of the options in the rate is to use a unit number of units, a charge on the number of units. So if you don't like any of those tax formulas, you have the ability to put your own formula. And again, tax registrations, you can play with the first party, the third party and custom suppliers, put various registration codes in. Also, when you're talking about, if you like, the tax advanced configuration, then any of these aspects, and in later chapters we will expand these. So you've got this concept of a configuration owner. If you've got various legal entities or business units that share the same setup, then you can put these in what's referred to as a common configuration. So we have multi-legal entities or business unit share, say, the Great Britain VAT setup if I had 3 or 4 companies registered in the same country. Or I can have very much party-specific setup that's relevant just to that one legal entity or just to that one business unit. Tolerances. I can set up various tolerances from the regime to the tax, to the rates, to the status, and I can also have various tolerances set up on the application and the event, and there's a hierarchy of which is involved. And cut a long story short, if your tax calculated amount is above tolerance, that will put the payables invoice on hold. You then have customer-based exemptions. You can also have product exceptions, and they could be incorporated both in a sales and a VAT. Traditionally, exemptions and product exceptions have been used in a sales tax, but there's no reason why you can't introduce those into a simplified regime to rate if you're configuring a simplified regime to rate for a VAT system. Most countries will probably have something to do with withholding tax. So if you're receiving invoices from professional services, Normally various, again, lots of rules and regulations, so it tends to be slightly different in each country. But the crux of the concept is that you don't pay fully the supplier, you withhold a proportion of the invoice and you pay that directly to the withholding tax authorities. So we'll have a look, two ways to set that up in the system. We're going to have a look at using the tax engine to set up my withholding tax. Also more specialist, but again, you could be applied as you build your rule. You've got delivery-based tax calculation. So is my tax point the point of receipt, the point of invoicing, or the point of payment? And obviously that delivery-based tax will influence what appears in my tax reports. Tax thresholds, you can set up for various taxes, a maximum in terms of amount or maximum rate. If it goes above that, it always shows the maximum. You can have a minimum in terms of amount or rate, again, which the tax would not fall below. Tax spot allocations, this is this Swizzy in terms of rule-based engine again, whereas you could combine a whole host of status and rates you defined against a tax box. A tax box is, as it sounds, on my tax return, I've got a particular box, whether it's sales tax, input tax, etc., whether it's exempt or zero I'm recording, and you can map all your rates to that appropriate box that you're going to send on your legal in terms of tax reports. Now, in terms of this, again, I've picked this from the implementation guide, and it just expands the complexity of tax, and I like this. It shows you there is 3 options. So in our previous slide, we said there was 2, in terms of simplified tax or use in terms of complex rules, but I prefer this with a little bit more detail. So it says no tax rules required, but it still means here, majority of our work in configuring the advanced tax engine is on the regime to rate. So here, my status rates recovery is defined by my default rules. Tax rules aren't required, but as I said, you can still build in a great flexibility. So you could use products or a group of products, tax exceptions. The locations in a location sales tax, the different jurisdictions will drive the status and rates. You can have party exemptions. That party plus items could include a whole host of exemptions. And it says the final point on my supplier profile, I can still go on and switch off a supplier to say this is not applicable. Perhaps it's under registered, it's under the reporting threshold, so it's an unregistered supplier. All of those can be used if I would define in the core foundation setup. You then got, and again, this is probably where people would argue the more you've implemented this, the difference between simple and complex is probably not that great. But for simple rules, again here, most of the time your indirect direct defaults will put in the correct status rates recovery. So you've got a few exceptions. So it could be number of parties, a number of products, a combination of the two, might be certain business types of transactions that will override those defaults. The ultimate end, and my experience, this is where you get drawn quite quickly as you get into all the details of the regulations. Again, depending what type of products and services you supply in terms of whether they're multi-geographies or within a single geography. Here, the defaults, again, put majority of the case, but majority of the time they're then overridden by the exceptions or exemption. So here we have a whole host of rules like origin, destination, registration, status, service, or a whole combination of those will drive a tax. And it also says we might have tax on tax. And in terms of for there, just the basic simple regime is not sufficient. You'll end up with a whole host of condition sets driving your rules that will drive the tax. So just to finish off, let's go and have a look at the application. And what I'm going to do in the application is I'm going to use the tax simulator. So just re-logging on. And as I log on, what I'm going to do is we've got this very useful tax simulator. So I'm just going to go to setup and maintenance. And in my project here, look, and I'm going to look for transactional tax. In terms of this core setup, required setup, it's as simple as regime, taxes, tax rates and recovery. A majority of those can now be configured via the use of a spreadsheet. If I go to all tasks, this is where we start to see I've got where I can put determining factors, my condition sets, my tax rules. And what I'm going to do here is I'm going to look at my manage simulator transactions. And this is really, in terms of cool, I can pull in transactions from the system. So if I think I've got invoices, purchase, supplier invoices, etc. that are at fault, I can pull them in here and simulate them either with taxes I'm about to apply or taxes that have already been switched on for transaction. So this simulator also emphasises a lot of the core concepts of the tax engine. So first of all, the event. Is it an order to cash or procure to pay type flow? So here I'm looking at a sales invoice. I could link it to some type of document, i.e. process. I'm not in this case. In terms of when we're talking about the first party, here I'm looking for the UK legal entity. And that defaults in and stamps the legal entity.